The Fed is not going to take care of the problem. The Fed created the problem, and it's going to make the problem worse. And so they should be buying gold. And eventually they will be buying gold. Now, whether some people buy Bitcoin instead of gold or in addition to gold, who knows, right? Some people might decide to do that, and that might push the price of Bitcoin up. I don't know. But even if it goes up, it won't stay up. Eventually it's going to collapse. So whether it has another rally before that collapse is anybody's guess.
But why do you think that Bitcoin will collapse?
It's not a substitute for gold.
Why do you think Bitcoin will collapse and gold won't collapse?
Because gold has real value and Bitcoin does not. So Bitcoin's price is a total reflection of speculative demand.
Hey financial gladiators, welcome Token Nation to today's financial showdown where Peter Schiff, aka the Oracle of Oops, spills the beans on Bitcoin and drops some serious truth bombs about the US economy. With Jerome Powell looking like he accidentally ate a ghost pepper, we've got to wonder in this wild game of Monopoly, where's the best place to park your money? Stocks? The ever-shiny gold? Or in the cryptic world of cryptocurrencies? Brace yourselves, Schiff's gearing up for a revelation.
Gold is better money than any other commodity we've tried. But Bitcoin is not money. It's not a commodity. It has no use. It is purely a function of psychology and perception and demand. If people think the price of Bitcoin is going to go up, they're willing to hold it. They're willing to buy it. But they don't use it as a medium of exchange. They don't use it as a unit of account. They use it as a speculative vehicle.
I'd argue that Bitcoin is probably more used as a medium of exchange now than gold is. I mean, gold is probably more used as a store of value, but I think Bitcoin is much more used now as a medium of exchange. People can make electronic payments from one person to another very quickly.
Gold's been flexing like a seasoned bodybuilder, flaunting its 30% muscle gain over the past 5 years. Bitcoin? Kind of like that gym newbie promising gains but getting stuck at the bench press. So when the financial gym gets crowded, who's your spotter? Gold keeps it cool, while Bitcoin can be a bit unpredictable. Little wonder, gold's the poster child for the inflationary gym.
Michael Saylor is down on his Bitcoin. His average price is a little over 30,000. So he's down about 10% on the billions he put into Bitcoin, and he's not earning any interest. If he just would have left his money in the bank, he could be getting 5% interest.
I mean, do you earn interest? Do you earn interest on gold? You don't earn interest on gold.
No, but this is different, right? Saylor was the big guy saying all companies need to get rid of their cash, and put it into Bitcoin because you can't earn any yield. Well, now you can earn 5% on your cash. You're still getting nothing on your Bitcoin, and the price is going down. Look at that fool up in El Salvador. You know, his average price for the Bitcoin he wasted the people's money on.
Over in the international locker room, China's hoarding gold like it's going out of fashion. But why, you ask? They're planning an all-star team against the drama diva, the US dollar. Word on the street? A new currency, sprinkled with a touch of gold, is in the works. Given the US's tendency to pass out sanctions like gym flyers, some are ready to switch teams. Schiff's even calling for gold to hit the heavyweight division at $5,000.
Part of the reason that Bitcoin went up was because Michael Saylor was buying it. His initial buying helped push up the price. That's the reason it went up, because he moved the market with his size. Where do you think Bitcoin would go if Michael Saylor tried to get out? Oh my God, that thing would collapse. Especially if he let everybody know that he was going to get out.
Yeah, I mean, there would be a $4 billion. I think he's got $4 billion worth of Bitcoin.
Now imagine this. Michael Saylor, in a twist, decides to offload his Bitcoin like it's a clearance sale. Result? A market plunge worthy of an Olympic dive. Gold, though, isn't about that life. Big crypto names selling off is like watching a protein shake spill, messy. But wait, there's the Bitcoin halving event. Kind of like a surprise double spin class. With its history of intense workouts, we're gearing up for another sweat fest.
If I look at America, and America was a company, I would say America is insolvent. I mean, $33 trillion worth of debt, $1 trillion worth of debt repayments a year. I keep saying that if the US was a company that was listed on the American Stock Exchange, the directors of the US would probably need to go to jail now for being negligent in their trading.
Picture this. You go to bed with a full piggy bank, and by dawn you're scrambling for loose change. That's the kind of financial musical chairs we're playing with US dollars and treasuries. Confused about rising costs? Think of it as the monthly gym fee that just keeps, well, inflating.
The United States owes a lot of money in addition to that $34 trillion, because it's closer to 34 trillion now than 33, so might as well round it up. But there are all sorts of contingent liabilities that any, company is going to have to account for. Any company on a stock exchange lists on its balance sheet the contingency liabilities. And so if you look at those liabilities, you're talking about another $100-200 trillion. I mean, some huge number that actually dwarfs the bonds. But these are still obligations that the United States government has, accepted, which would include the obligation to pay Social Security benefits to people who retire, Medicare benefits to people who retire, the obligation to reimburse banks for any losses on student loans, the obligations to reimburse banks, depositors for any money that is lost in the banking system.
Deep breath, folks. The U.S. national debt is expanding faster than a cheat day gone wrong. Once viewed as just some extra calories, this debt diet has people now frantically searching for a financial Fitbit.
If you think about it, we have a $34 trillion national debt. 10% of that is $3.4 trillion. So we obviously can't pay 10% of that number, let alone the number that it's going to grow to over the years, because we're adding trillions of dollars to that pile, right, every year. And very quickly, 100% of the government's tax revenue
is going to
go to interest on the debt. I mean, even at the current rate of interest, where about 5%, in a few years, I don't know how many it is, 3-4 more years, based on the way the national debt is rising, all of the government's tax revenue will have to go to pay interest on the debt.
Here's our fitness dilemma. We've got this mountain of debt that won't just squat away. Erasing it might strain the system, keep bulking. The U.S. could face an international timeout. Banking on gold? Remember, even the mightiest can face a tough set.
U.S. government collects income is 3.97 trillion for the fiscal year 2023, and of that, 1 trillion is going to repay debt. Am I right in saying that 25% of what the government?
No, it's not going to. Yeah, it's not going to repay debt. It's going to pay interest on the debt. None of the debt's getting repaid. It's just the interest. Repaying the debt is impossible, but servicing the debt is also going to be impossible because there's too much debt to service, and the interest rates are going to be too high. So if the government only collects $4 trillion in taxes, what happens when $4 trillion is our interest on the debt? Because we're going to be there.
What happens when the economy slows down slightly and they're not collecting 4 trillion, they're collecting 3.5 trillion or 3 trillion because the economy slowed down and people are paying less tax?
The buzzer's ticking, and with every tick, the room gets tenser. How do we lift this massive weight of debt? Some suggest a slick financial maneuver. Reminds you of 2008's gym stunt, doesn't it? That move may have saved the match, but the echoes of its repercussions are still resonating. And looming in the backdrop, hyperinflation, the uninvited guest ready to crash the fitness party.
When the economy slows down and people are paying less tax, the budget deficits go up. And so instead of a $2 trillion budget deficit, we have a $3 or a $4 trillion budget deficit, which is adding more supply to the market, putting more upward pressure on interest rates or more pressure on the Fed to monetize those larger deficits by creating additional inflation, which undermines the attractiveness of those bonds and causes fewer people to buy. Look, we are at an inflection point where we have to choose as a nation. Is the U.S. government going to default on these obligations, or is it going to inflate them away?
But hey, keep those headbands tight and water bottles ready. Who knows, the next move might just steal the show. To victory.